Hi, my name is Marcial. I'm an enrolled agent and tax preparer, mostly specializing in international tax. And today I'm going to talk about the implications of owning real estate offshore. This is for anyone who's a U.S. citizen or resident who owns property here in Costa Rica or in any foreign country. I'll kind of be going over the general filing requirements as well. Depending on how you own the property and the activity of the property is depending on how it gets taxed and what rate. So the first thing you need to know is the ownership of the property. Do you personally own it? Is it owned by a corporation, whether that's a Costa Rican corporation or another foreign corp? Or is it a partnership? Do you have an agreement with another person to carry on an activity here in Costa Rica with a property? Then that would be a partnership. And there's also what's called an election to disregard. So even if you have a foreign corp, you could make an election to say, you know what, I want to forget this foreign corp and I want to tax it as if it doesn't exist, and I would just still want to operate it as if I own it personally. So those are basically the three conditions of ownership. And then there's character of income. So there are generally three characters of income. It's either a capital gain, so you purchase a property, you fix it up, you flip it and sell it. That's capital gain income. There's passive rental income. Passive meaning you're not active, you're kind of passive meaning like you're sitting back and it's being rented out. And then there's non-passive. That means you're actively managing the property and you have a more active role in the management and rental of the property. So that's the character of income. And then there's some special circumstances if you pay foreign tax. So you get a foreign tax credit, or if you have like a 1031 exchange. So a 1031 exchange, in case you don't know, you could, let's say you have a capital gain, you bought a house for $100,000, and instead of selling it for $300,000, you have a capital gain of $200,000. What you could do instead is do a 1031 exchange through what's called an intermediary, where they exchange one property for another, and you don't pay any capital gains. But with the current laws, you could only do it with a foreign property to foreign property.
Like properties.
Right, yeah, they have to be lifetime. As part of the new tax law, it actually only applies to real estate. And then there's involuntary conversions, which are like if a property gets demolished or the government takes it over or forced to sell it through a bankruptcy or some sort of other circumstance, you may have to record a capital gain if it's involuntarily converted. So those are some special circumstances. Rental income and loss, if you personally own, so it's not in a foreign corporation. The tax treatment is pretty much similar to the U.S. You get passive activity losses, or if you're a real estate professional, you get losses of to $25,000. So you get to lose up to $25,000 and claim all that in the first year for rental income. The only real difference is depreciation. So the house in the U.S., you depreciate over 27 years. With the foreign property, you depreciate a little bit less, over 40 years. That's really the only main difference. And if you pay foreign tax, you get a foreign tax credit. So let's say you rent out a property that you own personally, and you pay $1,000 in foreign taxes. You get to claim that $1,000 as a foreign tax credit against any income from the rental property. So keep that in mind if you own it personally, again, not in a corporation. Again here, if you personally own, if it is your primary residence the last 2 or 5 years, you get the $250,000 capital gain exemption. That still applies for foreign property, so whether it's in the U.S. or foreign, you still get that exemption. And any capital gains similar to the U.S., you get to lose up to $3,000 per year, or you get to offset those losses with any other capital gains you had during the year. So it's the same as the U.S. The only difference again here, foreign tax credit applies. I believe Costa Rica just started like the capital gains tax. So now if you sell property and you pay capital gains, you get to claim a foreign tax credit.
Okay.
And just also so you're aware, the way the foreign tax credit works, it's kind of broken up into characters of income. So like dividends and capital gains, there's a foreign tax credit applicable to that, and there's another one like for wages. So if you're paying foreign taxes on wages, they get separated. So if like, let's say you pay a whole bunch of foreign taxes in your wages, you can't use those to offset a capital gain that you had when you sold the house. So just keep in mind those are separated, but your tax preparer kind of will go over that. So partnership, so this is really if you own a property or manage another property with another person, operating it as a partnership, it just needs to file a partnership return. And again, very similar filing requirements to the US. And this is if it's not in a foreign corp. So just keep that in mind. If you are in agreement with someone to operate an activity here, it needs to possibly file a partnership return if it's not in a foreign corp. You need to file a form, at least one form for each foreign corporation you have. It's usually Form 5471. If the foreign corporation is controlled more than 50% by U.S. citizens or residents. It's an information reporting, so there is no actual tax effect, but the reporting of information varies based on the ownership percentage. Generally speaking, the more ownership percentage you have, the more information and schedules you need to report. And if you own 100%, then you need to report basically everything, profit, loss, balance sheet, activity, and what are called like monetary transactions between you and the foreign corp. So if you're contributing property, that needs to be reported. Any dividends paid, that needs to be reported. So depending on your ownership, depends on how much information you have to report. And there's a separate form if you are sending in more than $50,000. So usually during like an initial capital investment or purchase, if you're sending in more than $50,000, there's another form for that. And like I said earlier, an election can be made to disregard it. So if you don't want to deal with this form and you want to be taxed as if the foreign corp doesn't exist, you can make an election to do so. But there's another form you need to file annually to continue that election to disregard. Well, there are certain circumstances where it's beneficial. So for example, like if you own the home personally and you want to get the capital gain exemption, let's say you're going to sell it and you know you're going to have a $50,000 capital gain. You say, you know what, I'm going to elect it to treat it as my personal residence. Okay. That way I get the gain.
Can you tell everyone what's the penalty for U.S. citizens who do not report their corporations?
Yeah, so it's $10,000 per year per foreign corp. So make sure it's filed timely as well. There is a procedure to have it abated if you meet reasonable cause conditions, and I've worked with a number of clients to go through that. The IRS is usually pretty lenient on that, but it's $10,000 per year. Generally, income is taxable by the shareholders upon receipt of dividends, and the income can be deferred. So just like a U.S. corporation, if you own stock in Apple, for example, you don't get taxed until Apple gives you a dividend. So you could defer income. So let's say a foreign corp sells a property or has rental income. Generally speaking, you could defer that to the next year, or you could space it out over a number of years to kind of help reduce your overall tax rate depending on the situation. And shareholders can receive wages if they are working for the foreign corporation. Now, side note, dividends, the difference between ordinary and qualified dividends, if the corporation has a tax treaty with the United States, then they get the special qualified dividend rate, which is a little bit lower. Because Costa Rica does not have a tax treaty with the United States, the dividends from a Costa Rican corporation are taxed as ordinary income, so subject to the ordinary tax rates.